Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week. Stocks I'm watching, economic news you need to see. And until last Friday, it looked like the market was ready to give up a lot of last year's returns. Stocks had sold off every day of the new year, and investors were getting scared. Do not let the stock sell-off fool you. There is very good reason to believe that 2024 could be a very good year for investors. In fact, I'm going to detail why it's starting to look a lot like the mid-90s and one of the best bull markets we've ever seen. Stick around after that, and I'll cover some important news on some of the stocks we've talked about here on the channel, including MPW, WBA, and SoFi. First though, if you've ever wondered what's in my portfolio and want to see the stocks I'm buying, you can now by joining me on the Blossom social investing app. It's like Twitter, but for investors, and without all the drama. The app was created by YouTuber Brandon Beavis for investors by investors, and I just started using this last year, and I love the app for getting more ideas and sharing my portfolio with you out there in the community. And I know what you're thinking, not another social media app, but this one is much more than that. You connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see insights into your portfolio like percentages and average dividend yield across the entire group. You'll also be able to join a community of more than 70,000 investors in their social feed to see what everyone is talking about. I've shared my portfolio on the app and it's totally free to download, so look for the link I'm going to leave in the description below. Back to our main topic though, because stocks sold off last week with the last year's best performing sectors giving back even more. Shares of Apple plunged 6.4% on multiple analyst downgrades, and the Magnificent Seven gave back an average 3.5%, more than twice the pain seen across the broader market. Other growth stocks sold off even harder, like SoFi Technologies, ticker SOFI, falling 18% on the week. Understandably, investors got scared, but has anything really changed on the outlook for this year? Now understand, if you are a short-term trader, then yes, you need to make decisions based on market sentiment and the technicals for where stocks might go over the next days or weeks. If you are a long-term investor, though, look further out than that and just have the confidence in your outlook and the environment for stocks this year that could be in for a very strong period of returns. That's because the narrative right now is for what's called a soft landing. The alternative, of course, would be a hard landing, is where increased costs to borrow push the economy into a crash of unemployment and recession. But so far, it looks like that soft landing narrative is happening. The Fed's fastest interest rate increases in 40 years has brought the rate of inflation down from 9% in 2022 down to just about 4% last month, and is expected to fall further to 3% by the end of the year. Real GDP, or economic growth adjusted for inflation, was 2.9% in the third quarter, the highest in more than a year, and it looks like it's going to remain above 2% over the next few quarters. Now, if that scenario sounds familiar to old-timers like myself, it's because we've heard this story before, and it led to one of the best bull markets in history, the 1990s. The Fed raised rates for more than a year starting in 1994, increasing its Fed funds rate from 3% to 6% by March of 95. Just like when the Fed started raising rates recently, stocks in the S&P 500 fell 5% when rates went up in 1994, but the move worked with inflation leveling off and then coming down over the next few years. The economy made that soft landing, growing at 2.2% in 95 and then booming on from there. And the rest is history. Stocks went on to one of the best bull markets we've ever seen, rising from 470 on the S&P 500 to over 1,500 over the 5 years for a 26% annual return. Tech stocks in the NASDAQ did even better, up 500% or 43% a year. Another factor makes the current outlook a lot like the 90s as well. Artificial intelligence could drive the same kind of productivity gains that we saw from that internet boom 30 years ago. The year-over-year change in worker productivity jumped from just 0.25% in mid-1994 to as high as 2.5% in 96 and was above 1.5% for much of the period. Nation, the important point here is just to not get scared out of your stocks during these little pullbacks like we saw last week. Over the 60 months in the late 90s bull market, stocks fell in 14 of those months, including a heart-stopping 14% correction in August of 1998. But investors that stayed in stocks were rewarded. Now, if this scenario plays out, the mid-cycle stocks should do especially well over the next year, and that includes stocks in the industrials like chemical makers, as well as the regional banks and stocks of smaller companies. But in this kind of bull market, everyone that has the courage to stay invested will make money. Now let's look at some of the stocks I'm watching this week, including some very important updates on some of the stocks we've talked about here on the channel. First up here, Walgreens Boots Alliance, ticker WBA, cut its dividend for the first time in 47 years last week and saw the shares plunge as much as 10% before closing out just 3.8% lower on the week. In fact, the shares were initially up pre-market when the cut was announced. Now, this stock will be dropped from the dividend aristocrats and some of these other dividend growers list. Dividend investors were freaking out, even though it's still a respectable 4% dividend yield. Shares were up 22% from our mid-October video revealing a strategy to sell the Boots pharmacy chain, which the company has since confirmed that it will be doing, and now the entire company could be up for sale. Folks, the dividend cut is a classic move to shore up its cash flow to make the company's finances look better to a buyer. Walgreens is going to get upwards of $7 billion for that Boots sale or an IPO, which drops its revenue, but also helps pay down some of that $32 billion in debt. The stock is now selling for just 0.33 times on an enterprise to revenue basis. Now that's the enterprise value, which is the stock market value, plus and minus, minus all the cash on the balance sheet, plus adding back the debt. So it includes the debt for these highly indebted companies, a very important valuation metric for these indebted companies. But that is extremely cheap at a 30% discount to the EV to revenue multiple on CVS and a fraction of the 1.8 times EV to revenue multiple that the company has traded at just over the last year. Nation, this is a private equity wet dream, okay? A market share leader with many segments that can be sold off to restructure and recapitalize and then selling at a steep discount because of just an industry-wide slump. I picked up more shares when the stock opened 10% lower and expect we see a $30 each on any private equity or a merger offer. Medical Properties Trust, ticker MPW, was not as positive though, plunging 29% Friday to a new low after the company said it hired a legal advisory firm to consult on options for its Steward tenant. Management also said it would take a $350 million write-down on the owed rent, as well as providing another bridge loan to Steward. I continue to hold the shares, but I am not adding more here. The company has a valuable portfolio of over 400 properties. It is the largest hospital owner in the United States and it has a lot of options here, but it just continuously goes deeper into that commitment to Steward and its other biggest tenant Prospect. Now, Steward is almost definitely bankrupt without the support of MPW, and it's very uncertain whether the hospital operator can sell enough assets to save itself. At this point, I think the market is pricing in a bankruptcy by Steward and a total loss on that owed rent and the equity involved with MPW. Now, I'm still confident that MPW, though, has the assets and the cash flow to get it through this year and see those lower interest rates push real estate valuations higher. That's really one of the main themes this year. Those falling interest rates is going to support the real estate market. That's going to give it the critical lifeline it needs to sell just enough assets to pay down that upcoming debt, start building the share price back higher. I'm also watching the Chinese stocks, especially Alibaba Group, ticker BABA. I know a lot of you won't invest in the Chinese stocks despite it being in no way a support or an affirmation of the CCP. Folks, the government does not get any of that money you invest in these stocks. It just goes between investors. But many of these stocks are flashing buy signals stronger than I've ever seen them before. The gap between the earnings yield on Chinese stocks and the 10-year treasury is now at 8%. That has rarely been this high. In fact, there's only been 5 times that the earnings yield on stocks reached over 5.5%, and the stocks rose in the following year every single time, and by 57% on average. Now, of course, being cheap isn't enough alone for the stocks to rebound, but the government is pushing through progressively more stimulus, and any sign of an economic rebound could have investors rushing back into these shares. Again, I continue to hold Alibaba, ticker BABA, as well as the CSI China Internet ETF. That's the ticker KWEB. Giving you that bigger picture with the sectorspiders.com sector tracker. Great free resource here on the internet. We can see 4 of the 11 stock sectors closed higher last week, with utilities and consumer staples really filling their traditional roles for that safety stocks, while the drug makers in healthcare continued to rebound from last year as well. Oil stocks also did well on a bump higher in the price of crude. Unfortunately, it wasn't nearly enough to counter that big drop in tech stocks, especially with the weight of the technology stocks in the S&P 500 index. This is a problem I highlighted last week in that technology is now 29% of this index, and the Magnificent 7 stocks alone are nearly 30%. That makes it very difficult for the rest of the market and just investor sentiment, because any weakness in the sector in tech stocks or those big tech companies is going to drag down the rest of the market. While I do believe we're still heading into a very good year for returns and possibly several good years, this next few weeks could continue to see those biggest stocks and just the overall market give back some of last year's returns. Zooming out here, the sectors most known for dividend stocks underperformed last year as those rising rates really pulled investors out of stocks and into safer money market funds. That could reverse this year as the Fed rate cuts lead to those lower cash yields. The average money market yield is already down to about 4.3% from nearly 5% last year and could be under 3% by the end of this year. As that rate falls lower, investors are going to start moving their money back into stocks of utilities, consumer staples, and real estate, pushing those share prices higher. Fourth quarter earnings start coming out this week. Very important time for the market, and the major banks are starting that on Friday here. Analysts expect companies in the S&P 500 to report earnings growth of just 1.3% from the same period in 2022. Now, those expectations are actually down 8% from just 3 months ago. Okay, so 3 months ago, at the start of the quarter, analysts expected companies in the S&P 500 to say they grew earnings by 8% over a year-over-year basis. Now that's just 1.3%. Now, while it is normal for analysts to lower their earnings expectations through the quarter as more data becomes available and the kind of that numbers game gets played out, the average revision here over the last 5 years has been lower, just 3.5% lower. So to go from 8% to 1.3%, you can see here, this is the chart on FactSet Earnings Insight, the change in quarterly bottom up over the 3 months. So we see here over the last 3 months, analysts revised lower their earnings expectations by 6.8%. But despite that, retail sales in the job market remained strong throughout the final 3 months of the year, and the overall economy likely grew at a 2% plus rate. The idea that companies will now only report 1.3% earnings growth strikes me as ridiculously low, and it should be a strong positive earnings season when management easily beats these expectations. Join me on the Blossom Social Investing app with the link below and see all the stocks in my portfolio. Or click on the video to the right for my complete 2024 investing plan, how to invest in 2024, and the 10 stocks I'm buying. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.